Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Matthew Le Merle. How you doing today, Matthew?
I'm very well indeed. It's great to be here, Kirk, and I'm looking forward to speaking to your audience.
Yeah, great. Well, before we begin, Matthew, tell us a bit about your background before we get started here.
Oh my gosh, how long do you want to go? No, I'm English, grew up in the UK, came to America with my wife, Alison Davis, a long time ago for business school, never went back. First career, senior partners, large consulting firms, ran the global financial group for one, the global digital practice and innovation practice for another. It's all a long time ago. But 25 years ago, we became investors, internet, fintech, digital content. Alison also ran a private equity firm and was the CFO of BGI, which is now BlackRock, world's largest asset manager. And we slowly became more and more of the opinion that value was about to be digitalized. And so when we first saw Bitcoin back in maybe 2012 or 13, we took an interest. We ended up pivoting 100% into being blockchain investors. And that's what we've done for the last decade or more. So today, that's all I do, early stage and mid stage venture investing in blockchain companies and projects. We've invested in about 1,500. We're investors in about 100 blockchain unicorns. And I live in San Francisco, have a second home in London, and really enjoy working with the entrepreneurs in the space.
Nice. So what caused you to want to pivot into blockchain? I mean, there's a lot going on in the world, a lot of new technologies. Why blockchain?
Well, I think to answer that, you have to sort of say what I just spent 30 years doing, which was digitalizing communications and content with the internet technology stack. And we take that for granted now. But we all know that that was a defining moment for the world at large and for every industry, every business. We all rely upon the internet today. You and I are using it right now. From an investor perspective, it was the greatest value creation event the world's ever seen, bar none. It's driven most of the alpha, not only in venture, but in public equities, believe it or not, for the last 20 years. And what we saw 10 years ago or 12 years ago was that the second shoe was dropping. We've digitalized communications and content. We haven't yet got round to digitalizing commerce and finance. And now we saw a technology, which is the blockchain, that was going to enable the digitalization of all of the world's assets and monies and commodities. And in so doing, we were going to be able to do real-time, fr relatively frictionless transfers of value over the internet. And that was a very big thought. At the time, Alison was on the boards of First Data and Fiserv and NatWest RBS, and I was working with some of the world's largest tech companies, including PayPal and Google. And I think we could see that this value creation exercise that was ahead of us was going to be bigger than that of the internet timeframe. So as investors, you normally only see one of these in a lifetime, and here was the second one coming. And so we just went all in.
Nice. So, when you before we kind of dive right in, I want to get some terms explained because I think some of the listeners might not understand. What's the difference between blockchain, crypto, and DeFi? Just so in terms of throwing around, people truly understand.
Yes, thanks, Kirk. So I'll try and keep it simple, but already you've asked a very complicated question because they're overlapping. And so the first thing is the internet sits on a technology stack. There's hardware, software, applications built on top. Blockchain, or better said, distributed ledger technology, is a complementary technology to the internet stack. The internet is not very good at a number of things, including security, identity. It has no system of trust embedded in it. And so when Satoshi Nakamoto wanted to create a peer-to-peer cash that could work over the internet, something more was required. And so distributed ledger technology was created. as a complementary technology to the internet to enable safe and secure movement of value over the internet. So blockchain or distributed ledger technology is a technology that complements the internet and allows us to have secure ownership, provenance, records stored in databases that can be leveraged to enable the movement of value over the internet. So that's the first point. Crypto is a subcategory of digital assets. All right. So we can digitalize any asset through a process called tokenization. Tokenization is another technology. We happen to sit tokenization on top of DLT or blockchain. But tokenization is a technology that allows us to digitalize the ownership record for any asset. And in so doing, we get rid of the paper and the people, and now we can move the asset digitally on digital platforms. So any asset can be digitalized. Crypto is a subcategory. Crypto assets are assets that began as decentralized distributed assets, and in most cases, they were born digital. So whereas I can take a dollar, tokenize it, and create a stable coin like Tether or Circle, most crypto assets are born crypto. They have names like Ethereum, Solana. We can talk about them later. So that's the second. Crypto is a subcategory of digital assets, and they all are benefiting from a technology called tokenization. And then your third question, what is the third category you asked? Sorry.
DeFi.
DeFi. All right. Now we're getting into the weeds. So whenever we move value, we have ways of doing that. And in the old world, we tend to do that with the help of intermediaries. So I can't send you, Kirk, $100 right now without relying upon a series of intermediaries. I call up my bank, asks me how I want to do it. They might have an app, which might be a Zelle I might be using Venmo. They might want to do a wire transfer if it was a larger amount, which might bring in other intermediaries. And then eventually the money gets to your bank, which is another intermediary, and they credit it to your account and they call you up and you now know. So the process of me moving value from me to you goes through a series of intermediaries, which adds a lot of time. It might take a whole week if it was a larger movement of value from me to you. It could take a lot more than a week if it was something like a real estate asset. It might take 45 or 60 days for me to transfer the ownership and the value from me to you, and you pay me for the asset, the real estate. And the costs are horrendous. So if you were living in another country, trying to get $100 of value to you, if you live in a country that doesn't use dollars, we might lose 25 or 30% of the value. The World Bank says on average we'd lose about 10% of the value for an international remittance. So it's slow, many hands get in the middle, there's a lot of friction, and there's some other issues like counterparty risk and security, which we don't need to talk about right now. DeFi is an approach whereby we eliminate the intermediaries, essentially. We have software that enables you and me to transact directly, theoretically, all the way up to direct peer-to-peer. So if it were direct peer-to-peer and Matthew and Kirk were just using the software, we might not have any intermediary involved at all. More normally, there would be an intermediary still. It would be a DeFi platform, and they are not really 100% DeFi, because even if they're enabling a technology platform, there's still an intermediary that hosts and services and supports the technology. So you and I still have counterparty risk because we're leveraging a technology that intermediary may have provided and maybe supporting. So blockchain is a technology. Crypto is a subcategory of digital assets, if we were talking about crypto assets, that were born typically natively digital and they're using tokenization on top of blockchain. And then DeFi is an approach, a decentralized finance is a approach to doing financial transactions without intermediaries and instead replacing them with software and code. Though I said there's a lot of gray area between these things and very few things are pure. So when someone tells you, well, it's DeFi, you still have to ask the question, well, is there an intermediary and is there counterparty risk? Or are you telling me this is really peer-to-peer and it's just Matthew and Kirk doing it directly with no risk and no intermediary?
Well, it's interesting. I appreciate you. I think it was great. I appreciate you kind of laying that out for people because I think a lot of people get confused. One of the you mentioned DeFi. One of the challenges I see is how is the current system going to adopt this? Because the current system is based around banks, which make a lot of money being the intermediaries, and they
Right.
love being the intermediaries, and there's a lot of lobbyists and whatnot built around them being the intermediaries. So blockchain, DeFi, all of the stuff is going to change that process. So, how do you see that happening, or do you see the banks just inserting themselves in another way? Like, because I don't see banks going away without a fight.
Well, Kirk, I think it's a fantastic question and a very important observation. And it's true, in fact, of all innovation. So, you can go back to the 90s and sort of say, well, email is surfacing right now, and Matthew and Kirk are trading messages on an email platform. Why isn't USPS, or for that matter, the Royal Mail, why are they not leaders in messaging platforms? Because they're the incumbents. They do it very well. They move letters and parcels pretty efficiently and pretty quickly, to be honest, to be fair. They were not bad at that. The problem is they had no skills or capabilities that made them fit for a world of digital messaging. And they lost out. And so here we are, and it's a long time, we're 40 years later, and we still have USPS and we still have the Royal Mail. They are much less than they used to be, and most of us don't use them very much. And in fact, we rely upon people with names like Google Gmail, or its equivalents to do most of our messaging. And in fact, email is now pretty old-fashioned, and a lot of us use other messaging platforms. So that observation is incumbents that were born with paper and people processes are very challenged to fully embrace born digital, natively digital products and services and approaches. And this is before we ask the question of vested interest. So if all we were talking about was, are banks well positioned to serve their customers with natively digital products? The answer is no. I mean, most of the technology that most banks rely upon is very old, is very creaky, is getting breached and hacked and phished and scammed all of the time. And it's not fit for purpose for even very simple things like micro payments in almost real time, which, I say that. I mean, the holy grail of payments is real time frictionless payments. And all the world's largest banks and payment companies have been trying to get there for a long, long time. Visa, MasterCard, Fiserv, Bank of America, JP Morgan, and they failed. They're pretty dismal, in fact, when it comes to moving small amounts of money quickly at all. So now you add in the notion of vested interests. And what I mean by that is back again, when the internet was rolling out, you could be a music company, you could be a film company, you could be a major newspaper or a book company, and you got whacked around the head by digital versions of your content. And most of you lost. So we know that. Most newspapers lost to digital platforms. The book companies got destroyed. The book retailers almost all went away. Amazon took over. You can go through, gaming. Most games, hard games, hardware games, went away, and everyone now plays video games and digital entertainment and so on. So that's what happened. And so if you're Jamie Dimon at JP Morgan, you know what happened to other industries because you saw it. And you don't want it to happen to your industry, but you know that as you rightly point out, Kurt, that you make all of your profits from inefficiency. That's the reality. Most banks make most of their money from float and fees and spreads and transaction costs that only are enabled by their inefficiency. If they were quick and easy, they wouldn't have float and they wouldn't have the ability to charge high fees, and all of that profit pool would go away. So obviously the big banks are not stupid. They're saying, we saw what happened to the content industries and the communication industries. We don't want it to happen to us. We're not ready. We're not fit for purpose. We know we need to upgrade. What are we going to do? And I think their strategy for the last 5 years, at least in the US, has been slow all of this down whilst we try and figure out how to get ready. And now I think they're getting more ready, but they're still confronted by the reality that these innovations are going to destroy the basis of their competitiveness. It's going to undermine what they've been good at in the past, their capabilities, and it's going to destroy most of their historical sources of profit. And of course, they're very frightened and very scared, and they should be. The good news is it's everything we're talking about today, Kirk, is inevitable because the digital natives, and they now are more than 50% of America, they're not going to stand for having to use faxes and waiting 45 days for a real estate transaction to close. They're just not going to stand for that.
Yeah, it's interesting you say that because there's a lot of technologies. I mean, supposedly Ethereum was supposed with smart contracts was supposedly solving a lot of this, and I've seen very little progress in that space. Now, I'm not living in there day to day, but I would have thought since these more or less came about that by now, I mean, I was learning about this in 2017, and here we are 8 years later, and we're still not using um, smart contracts. I mean, it might be in a small sense, but not in a major sense. I would have thought, hey, real estate transactions, that's simple. It's all public anyway. It's all public record, right? You go to the registry of deeds. None of that is being implemented. You'd think that would save a ton of time and money, and they could really make that much more efficient in many ways. But that hasn't happened. So I guess my question to you is, with all the obvious applications of this new technology, like why is it not being implemented in a larger scale?
Okay. So Kirk, I think the only thing that is wrong with what you just said is the time frame. Um, you have been looking at this for 8 years or 9 years, and that feels like a very long time to you. But in the context of how the world's industries change, it's a blink of the eye. So let's just go back again. You could do some very basic internet-based communication in the late 80s. By the early 90s, we had email and the beginnings of digital communication. We had the first few web pages. But the web pages back then were information only. You couldn't transact on a website. They were literally places you went to read things and learn things. And then by probably about the mid 90s, we had, high quality electronic commerce beginning, but it was really very rudimentary. And we forget that, all you could do at Amazon was buy and sell books, and they still got shipped to your home by they were physical books, right? I mean, they weren't downloadable KDP Amazon files. Kindle files. They weren't that. They were physical books delivered because you did the purchase electronically through a process of digital communication. By the end of the 90s, we were beginning to experiment, and I do mean experiment with downloadable content. But that didn't really occur until the zeros, and we tend to forget that. Amazon only began to do digital books and the end of the zeros. Apple only launched iTunes and downloadable music in like 2007 or 8, and we didn't have the iPhone till 2008. We didn't have apps till 2009. You couldn't have Uber until all of those things had already occurred. So there is some process where you leverage up the technology. And in that example, I've just run through more than 20, 25 years. Okay. So now let's go to where we are in blockchain and crypto. You've got to digitalize the payments first. You can't build complex products, which includes things like investment products or insurance products or borrowing and lending products on this new technology platform if you can't do the transaction, which means the payment. So where are we on payments? Well, actually, Kurt, we've come an awful long way in a very short time. Tether today transacts more than Visa or MasterCard. There's 400 million people using tethers to do transactions, mostly in the southern hemisphere, Africa, Asia, and Latin America. But nonetheless, 400 million people, it's probably somewhere between 15 and 20 trillion dollars worth of transaction volume, which, as I say, is more than Visa or MasterCard. And Tether is only a handful of years old, right? It's not 25 years old. So today, I think most people's expectations are that stablecoins will displace most traditional international remittances for sure, and probably domestic payments too. And so people like PayPal have their own stablecoin already. A bunch of banks are in the process of trying to figure out how to participate in stablecoins. The CEO of Bank America at Davos says, yes, we will have a stablecoin payment rail and we'll offer it to our customers alongside our other payment rails. So that's where we are. So there is a actually very quick technology transformation. We've gone from traditional payments to essentially real-time, low-cost, stablecoin-based payments in almost no time at all. In the world of technology, 7 or 8 years is very, very fast. Bitcoin, of course, is a multi-trillion-dollar asset. We can debate, whether or not we like it and do we believe in it, and are we really going to sell our gold and buy some Bitcoin? We can have a conversation about that. But, probably about 500 million people have put their hands up and said, yes, I want some Bitcoin exposure. So that's not none, that's not zero. And then we get to digital assets. And here it gets more complicated because, like I say, you can't really have digital assets working effectively if you don't have digital payments, because there's no point. If you have to do paper-based transactions in order to buy a digital asset, what was the point? The whole point is digital assets work natively on digital infrastructure, digital wallets, digital marketplaces. It enables real-time frictionless movement of the asset. So it's all building. It's a technology building. So is the glass half open, half full, or is the glass half empty? Your question was the glass is half empty. I'm going to tell you and all of your investor community, actually, no, the glass is half full. And we just made a huge amount of money filling it up half full. There's 100, almost 200 blockchain unicorns already. Those are companies worth $1 billion and more that are just building out this infrastructure. And they have names like Tether and Circle and Coinbase and Kraken. And if you weren't an investor in any of that infrastructure, you just missed one of the largest value creation opportunities of our time. And I'm telling you, it's just beginning. It's just beginning. 90% of the world has no exposure. 90% of the world's financial institutions haven't even begun considering how to use this technology. and the wealth creation and the value creation is all ahead of us.
Yeah, no, I appreciate the perspective there. And I want I guess the nature of my question is this is, you have a lot going on in the space, clearly. But I see in the front end, and you had kind of alluded to this in in your comments, but Bitcoin was the first. Ethereum was one of the first. I don't know which one it was, but it was up there. It's certainly one of the larger ones. Stable coins, we'll come back to stable coins, but um, I wonder, like Ethereum, and I have a lot of friends who are into this space too, and nobody seems to like Ethereum, but yet it's a practical use case. Bitcoin, what is Bitcoin used for other than speculation? I like Bitcoin because it's the first and everybody likes it. So it's this social network kind of concept where more people believe in it, the stronger it is. But well, how is it actually being used right now other than speculation?
Okay, thank you. So let's. I just want to do this. I said all the world's assets can be digitalized, and there's the process of tokenization, which is a technology that enables that. Obviously, Kirk, if we were talking about traditional assets, you and I would agree that it makes no sense, and it would make no sense to talk about a Microsoft share, a yen dollar foreign exchange transaction, and the purchase of a home as being the same asset class. We'd say those are not the same asset class. The Microsoft share is a public equity based on a technology company. The foreign exchange is just the transfer of monies back and forth, and real estate is a different asset class. So as soon as we start talking about Bitcoin, Ethereum, and a stable coin like Tether, the first thing you have to understand is they're in different asset classes. And this is really important. You need a heuristic, a classification system before you even begin to have any conversation about tokens or crypto, because the asset classes are very diverse. So I can take a money and digitalize it, and I have a tether or a circle. It's just a digital money. What's it worth? $1. Is it worth more or less than $1? No. The actual tether is only worth $1. You can have equity in Tether, the company, and then you can think it's worth a lot more than $1, because Tether is such a profitable business. But the Tether itself is just worth $1. I can take an ounce of gold. I can digitalize it. I can call it Paxos Gold. What's it worth? It's worth an ounce of gold. Nothing more, nothing less. It's a digitalized asset-backed security. By the time I get to Ethereum, what is Ethereum? Ethereum is an open source operating system. And the way to think about that is now we are comparing it to Microsoft. Microsoft and Apple and Samsung are technology companies that have very powerful operating systems upon which they build products and services that we use. And when we use them for whatever purpose: communications, content sharing, entertainment, education, and we pay transaction fees. We have to buy the hardware, we have to pay for the software, and we often have transaction fees associated with using our Microsoft phone or our Samsung, platform. So Ethereum is an open source protocol, but just for ease of, getting your head around it, substitute the word protocol for operating system, and you'll begin to understand what Ethereum is. Ethereum is a technology platform that enables a full stack of services, products, and applications to be built on top of it. And it has certain advantages and certain disadvantages relative to other operating systems and protocols. So now, Kirk, what went wrong with Ethereum? Nothing. Ethereum's growing really fast. Ethereum is getting more and more products built on top of it. The transaction fees are healthy and growing. The only problem with Ethereum is the speculation word that you introduced. A bunch of traders bid up the price of Ethereum well ahead of the intrinsic value of Ethereum. And so there's a lot of room for Ethereum to go up and down because of that reality. It trades, and traders in public markets can trade ahead of intrinsic value. They do that routinely. So you could never justify the price of Amazon over the last 25 years based upon Amazon's current quarter cash flows. And yet, if you didn't invest in Amazon on the way up, you constantly missed a value creation opportunity because everyone in the world was predicting the future value of Amazon. And in fact, that's how we do discounted cash flow, obviously. So in the case of Ethereum, I think people got ahead of their skis. They bid up Ethereum to a price that was so far in the future, decades probably in the future, that it gave it the opportunity to go down a lot, and it has gone down a lot. And so a lot of traders are very unhappy. And they say, well, Ethereum's dead. Ethereum's over. Ethereum's no longer a good trade. Well, if you're a speculator, those things may be true. But if you're like us, you're investors in technology, no, Ethereum's doing fantastically well. And it's on a great trajectory. And the problem is, as I say, the traders got ahead of their skis.
So you mentioned intrinsic value for something like Ethereum. How do you judge intrinsic value in much of this blockchain? Because
Right.
I'm curious how you would define that.
Right. So if it's okay, so this now for my sins, I worked on the McKinsey valuation book a long time ago when I was an analyst at McKinsey, and the valuation book was first being written. And and so this is a very interesting question, Kirk. And we could spend the whole podcast on this one question. Valuation in efficient markets, valuation in efficient markets, the benefits and risks of discounted cash flow. What can it do? What can't it do? The reality is that most discounted cash flows are driven by terminal values, which project today into the future, which in a world of innovation makes no sense. So so some things have clear intrinsic value. A dollar is a dollar, an ounce of gold is an ounce of gold. And if I digitalize those things, I know what the intrinsic value of those tokens is. An asset-backed token is pretty easy to get your head around. If it's something like Ethereum, I think we're now at the point where we can build discounted cash flow models for Ethereum and Solana and others. And in fact, people like VanEck have done that. VanEck publishes theirs. You can look them up. They're a very reputable Dutch asset management firm. I think they have about 150 billion assets under management. And they built a discounted cash flow model for Ethereum. But of course, it's innovation and technology. So most of the value is based upon your assumptions of the future growth, because that's just how discounted cash flow works. So you take it with a pinch of salt. How dark are your sunglasses? Because you're putting on your sunglasses and saying the future looks bright. How bright do you think it's going to be? By the time you get to Bitcoin, it's very complicated, Kirk, because the problem with discounted cash flow is the value that we quantify tends to be traditional monetary value. And we don't normally value something like safety or privacy or absence of existential risk that your government will steal all your money from you. Those values get embedded in the value of Bitcoin because hundreds of millions of people around the world say, I'm going to have some Bitcoin, not because of a traditional notion of value, but because I'm fearful. And I believe that my government may take all my money away from my traditional money away from me. They may hyperinflate my money. They may, I may be a refugee and the bad guy may take all of my physical possessions from me at the point of a gun. So for me, the value of Bitcoin is very high because it allows me to hide some of my wealth from those risks. So it becomes a more complicated conversation. And by the way, gold and diamonds have the same issue, right? The reality is, and all the gold bugs listening to this are going to hate this. The reality is we don't use gold for very much anymore. It's not even a very good conductor. So we don't really use gold. A platinum's a better conductor, and rare earths are much better conductors. So what's the intrinsic value of gold? It's that it's a store of value. And what is the biggest single use of gold, apart from keeping it in a vault? It's wearing it around your neck. And why do you wear it around your neck as jewelry? It's because you're displaying your store of value. It's not that there's any intrinsic value to the jewelry. The jewelry has no intrinsic value other than it makes you feel good because you're able to demonstrate your status relative to the women that don't have gold jewelry, right? It's that's all it is. It is a way for you to show your status, your privilege, your wealth in a display of wealth. Plus, some people believe that gold is a good way to diversify your wealth against other assets. It may have volatility characteristics which you appreciate. And if you live in India or Africa, you have a little bit under your mattress because if you're on the run, for whatever reason, you're a refugee, you can take the gold with you. Though we do know that normally, if you're a Syrian or a Ukrainian, someone at the border took all your gold from you. So the reality is gold was not a very good store of value if you're a refugee on the run. It never is, and neither are diamonds. So diamonds have a different issue, which is substitution, as you know, which is greatly undermining the intrinsic value of diamonds today. So it's a very long answer, but I think I just laid all of the defensive structure for getting behind Bitcoin. But I do not value Ethereum or Solana in that way. I think you can use discounted cash flow to have a point of view on Ethereum and Solana. I think Tether and Paxos Gold, they're asset backed. It's easy to get your heads around them. By the time you get to Bitcoin, it is more complex. And then the last thing I'll say, Kirk, is almost all the other tokens in the world have no value. They are crap. They are speculative only. They are just for traders who want price points to trade. They are chips in a great big casino. And we'd be the first to say that. We happen to be very active token investors, but most of the millions of tokens available in the world today are just speculative price points in a big casino.
So it's a great point. So one question is if there's a lot of coins out there, there's over 10,000. I don't know how many there are total, but there's certainly over 10,000.
Millions,
Yeah,
millions
maybe there's that many now.
We're actually millions.
So that being the case, and it sounds like, there's a few different types of digital currencies people can, or blockchain that people can invest in. How would you recommend people invest in this space? You think people should just be buying coins like Bitcoin or the companies, or what would you recommend if somebody's really interested in this space? How should they think about investing in this space?
Yes, thanks for asking, Kirk. So we actually we're very transparent. So we have a bunch of webinars and things at blockchaincoinvestors.com. We have one called Options for Investing in Blockchain and Crypto. We have another called Early Stage Token Investing. But I think the two first things that the investor needs, one of them I've tried to give you, which is some sort of understanding of the investment thesis. Presumably, as an investor, you're interested because you think there's a value creation thesis here. And I gave you that right at the outset, which is we're digitalizing all of the world's finance and commerce, and it's a complementary technology to the internet, and it's actually a bigger value creation opportunity. So that's one thing. You need an investment thesis. The second thing you need is heuristics for classifying the investment opportunities in the space. And one of those I just gave you, which because we began with tokens, and I said, well, you need to have a categorization of tokens. We didn't really complete that conversation, but it's, we have one and we're happy to share it, and you can find it at our website. Actually, before that, you need your asset classes. So, just as there is in technology, let's say life sciences, you have early stage venture, mid stage venture, late stage venture. That's all private investing. Then you have IPOs and you have public equities in the life sciences and healthcare space. Those would be, depending upon how you measure that, 3 or 4 asset classes. I would say it's three. I'd say it's early stage venture, mid and late stage private investing, and public equities. So I'd say in life sciences, we have three major ways to invest from an equity perspective. And we could talk about debt and other things if we wanted to. In blockchain, we have those same asset classes. So you can be an early stage investor in blockchain startups. You can do mid and late stage investing in pre-IPO unicorns, and then you can wait till it's public, and then it's got a name like Coinbase or Riot. It's a public equity. What makes blockchain more complicated is we also have the tokens. What makes it easy to get your head around is the tokens go through the same phases. So there's a formation phase, so you can do early stage token investing. There's some private rounds for tokens, pre-token launch. And so you can do private investing rounds, mid and late stage in tokens. And then once the token has its listing event, which is called the token generation event, once it's traded on exchanges, it becomes a publicly traded token. And that's just like a public equity. So now I've very quickly, Kirk, gone through 6 asset classes, right? 3 for equities, 3 for tokens, all in blockchain and crypto. 6 asset classes. The next question for your investor would be, well, what sort of investor am I and what am I good at? If you're a really good venture investor, I would say focus on early stage investing in blockchain, which is what we do. And what skills do you need? It's the same skills of any good venture capitalist. On the other hand, if you're very good at trading public equities, perhaps you should be focused on the public markets, in which case trade blockchain equities and large cap tokens, in which case you're going to start off with Bitcoin, Ethereum, and Solana on the token side, and Coinbase, Riot, Marathon, and a few others on the equity side. Why would you do that? Because you're a good trader. Why would you go early? Because you're a good venture capitalist. And then, of course, there are intermediary strategies for everything I just covered. So you can be an LP in a blockchain venture fund. You can be a LP in a hedge fund focused on crypto assets. And all those strategies still apply and are out there. If you asked me, all right, Matthew, that was too complicated for me. I just want to make a small initial investment to gain some exposure. I would say either read BlackRock, Fidelity, VanEck, and why they recommend that first baby step be a small Bitcoin allocation. They're typically talking about 2 to 4% of net worth at this point. If you read what each of those institutions have published, and they're basing that upon traditional optimum portfolio theory. They've just now included these new asset classes into their models. So that's one option. But recognize what you just did. You went into the public markets to gain your exposure. What do we know about technology and innovation? The highest returns come from being early investors. So you just chose a strategy which may have return attached to it. It's obviously got low risk, but it is more efficient. It's an efficient market. So theoretically, your return should be less. What have we done? We've gone to the other end of the spectrum, and that's the second recommendation I would normally make, though this is an educational only webinar, obviously, which is consider early stage venture investing. The world's richest people today are the people that backed Bitcoin in its early stage. And there's a lot more of them than people realize. The crypto wealth is enormous. I just read a report that says San Francisco Bay Area has now overtaken New York in terms of the number of billionaires and the number of unicorns we have by probably about 2x. A lot of that is crypto wealth, and that came from the early stage. It didn't come from the fact that they're traders in public liquid markets. So Kirk, taking that from the top, all of your investors need to understand the investment thesis. They need to understand the asset classes. They need to understand the best practices of being an investor in each asset class. They then need to look honestly at themselves and say, what am I good at and what am I not good at? And that would then define, are they going to act like a principal and do it themselves, or are they going to rely upon a third party and be an LP? And then all of the asset classes are accessible. And you need to figure out your overarching allocation strategy for your wealth. And certainly, most people are not going to put 50 and 60% of their wealth in this category. But if they don't have 5 or 10%, they're probably missing the highest returning assets of this time frame.
So, as we kind of wrap it up here, Matthew, one final question. I got a quick one at the end, but what's what are you most excited about in the next 5 years in this space? And how can people, what do you recommend? How do people invest in it?
So, Kirk, I believe in the investment thesis that I've already shared with you. Alison and I spent 30 years working around the internet. We didn't talk about that, but my clients originally were Microsoft and Cisco and Intel, and then it became Google and eBay and PayPal. And we did a lot of internet and digital content investing, and we benefited enormously from the arrival of the internet. And it was the greatest value creation event the world ever saw. I'm absolutely convinced that the next 20 years is a bigger value creation event. We are now digitalizing all the world's finance and commerce, and that is much bigger than communications and content. So, what am I most excited about? The digitalization of the rest of the world's transactional activity. And that's going to unlock a lot more value than we've ever seen before. And as investors, I could not be more excited about the opportunity to participate in that. And that's why, for Alice and I, that's what we've done for the last decade and more. So now you say, well, what am I excited about in the next 5 years? Well, this is going to be a 20-year conversation. So the next 5 years, some of the things are going to be we're moving out of the early phase into the mainstream adoption of this. And for those people who are listening and who have built models and done valuations, when a technology gets out of its early pioneering phase and moves into mass adoption, you have an inflection point on value creation. All your assumptions start going up very, very fast about how many users are there, how many open wallets are there, how many active monetizing wallets are there. All the numbers start going up incredibly fast because you hit the inflection point, and we are hitting the inflection point right now. So just to give you one tangible example, it's taken us about 15 years to get to 250 million monthly active users in blockchain and crypto. I am confident that we'll have another 3 to 5 billion digital wallets being opened up in that next 5 years. So imagine what that does in terms of driving fundamental value for Coinbase or Kraken or Robinhood, and all the other companies we back, the issuers of product, the platforms, the wallets, the custodians, the on and off ramps. I mean, it's just we're at the inflection point. So Kirk, I have a long-term view. I couldn't be more excited. But my 5-year view is incredibly positive because we've just hit the inflection point. And then, of course, America's come on board. And we couldn't do this whole podcast without mentioning that. America was trying to resist this technology for some reason that we do not understand. Now America is fully embracing this technology, And America is not only the global innovator, it's also the largest financial markets in the world. And you add those two things together, digital finance could not look more positive now that America's fully behind it.
Yeah. Well, I think you said it earlier in the conversation. The banks are trying to slow it down. That's the only, and they have a lot of power with the political realm because it didn't make sense to me either. One quick question, we'll wrap it up. I know this is kind of a fun question, but everyone's got their opinion on this, but who do you think Satoshi is?
You know, Kirk, I went very deep on that question when I first got started, and I actually wrote a book, and you can read the book. It's on Amazon and Apple and everywhere else, hardback, paperback, and Kindle. And it's called The Ministry of Bitcoin, and it's just a novel. It's for fun. Alison and I also wrote a very serious book called Blockchain Competitive Advantage for investors getting into the space. But I wrote a book, and I had points of view, and I did crazy things, Kirk. I took every word Satoshi ever wrote, I put them all into a database, and I had linguistic analysis done on the words to try and identify who this person might have been or people might have been. And I had names, I had hypotheses. Today, I think we should respect that Satoshi does not want to be known. Satoshi wants to remain anonymous. And I think we should respect their privacy. And so I'm not going to give you any names anymore. I regret actually that I used to try and breach their privacy. I feel like they haven't done anything wrong. They gifted the world one of the most important innovations of all time. They gave it away for free. We can all benefit from distributed ledger technology. It's a free invention, and we should respect Satoshi's anonymity. So Kirk, I'm happy to hear your speculation, but I'm not going to name any names.
All right. Well, I've got two speculations without naming names either. One is it's a small group of people who don't want to be known, which few friends of mine in the space have suggested is probably the accurate answer. My other one actually is more interesting, which is I think the government created it, and I think they did it accidentally in a DARPA-like program, and it was created to solve a problem, and it just kind of took on the nature of its own. So that's kind of my hypothesis. And wouldn't that be funny if that's what happened? All the people who are anti-government end up using a digital currency that was made by the government. So if I sometimes I like to think of as a life is kind of like a movie where it's just things just happen in such a way that like that couldn't possibly be the case, but it's just so on the nose. So I just find that that would be wouldn't that be the funniest outcome? That the government created it accidentally, much like the internet, which wasn't an accident, but they created something we all use every day. So
Yes.
that's
So,
my fun
so I would
hypothesis.
I would love for you, it's very cheap, to download the Ministry of Bitcoin in Kindle from Amazon.
All right, I'll
Uh,
read it.
I think you're going to enjoy it,
Yeah,
given what you just said. Actually, given what you just said,
yeah,
very specifically, I think you'll find it interesting.
yeah. Well, cool. Well, Matthew, I appreciate you coming to the show. I know we're out of time here, but I appreciate you coming to the show, sharing your wisdom with us. This has been great. I always enjoy talking about this stuff. There's a lot to come here in this space. Where can people find more about you?
So we're very transparent. So you can go to blockchaincoinvestors.com, and there's a lot of resources for investors there, free resources. And then if you want to get blockchain news every day, we also issued a daily podcast, news podcast, Block Talk AI. You can find it at Amazon, at Spotify and Apple podcasts. It's 100% AI. So it's 100% AI, no human intervention, but it's uncensored, free blockchain news every day.
Nice. Awesome. Well, thank you for coming on, Matthew. We'll have you on the future. I very much appreciate your wisdom today. So thank you.
Well, thank you for having me. I hope this was helpful.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, What does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. I mean, like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right, that was a great interview with Matthew. Really appreciate him coming on the show. Now we're into the panel portion of the show where we have our very own Barb Friedberg. Hey, Barb.
Hey, Kirk, happy to be here and excited to talk blockchain.
Awesome. Well, I know you're our blockchain expert, so
Oh,
glad to have
yeah.
you here. Yeah, we're in the summer season here. It's just me and Barb today. Everyone else is on
Yes,
vacation, so
just us.
yeah, just us chickens here talking. But we'll dive right in. So, what were some of your takeaways from the interview, Barb?
I thought Matthew was very well spoken, very educated, and really made a case for he's a venture capitalist, obviously, and hits on new stage blockchain type companies. And he's been doing that for 20 years. So he's got a lot of skin in the game and a lot of time under his belt. And he's obviously got a tremendous amount of commitment. So I thought the educational portion of the show, where he explained why he believes this is the place to be. I thought it was very educational, but I'm going to throw this out here, Kirk. I know. I am not, I invested in Coinbase at one time, but I sold after it dropped like 50%. I'm not invested in crypto. I'm not invested in Bitcoin. And as far as I know, don't have much in the way of blockchain. But count me as someone who was interested and wanting to learn.
Yeah, I might have even been the person that bought that Coinbase from you, Barb. So,
It went up after I sold it.
yeah,
Okay.
that was
So
me. That was me.
that
It was
was
all
you.
me.
Okay. Well, I'd like it back now.
Yeah.
Okay. Can you please send it back with the profits
Just
that I
just between us
forwent?
friends.
Yes. Yes.
Um, so it's interesting. I've been thinking a lot about the evolution of technology. And in the show, we've been talking a lot about AI and blockchain in the last 6 months and other technology. And I kind of harken this back to like the 80s, the 90s, where the internet was becoming a thing. Like, the tech geeks, the computer geeks that were literally creating their own computers, like the hobbyists no one else had one. Like I had one as a kid. It was like my parents got one. I was playing with an Apple IIe. It was just you had to like know how to like write, a code. It was just crazy. Like nobody knew anything. But these hobbyists, they were like building their own computers. It was crazy. Like they understood the internet and computers and all the opportunity was there. Now, everyone else, we had no idea. Like I was into computers as a kid. I still had no idea. Like it was just so far down the rabbit hole, like the internet and all that. Um, and what I find fascinating is there were so many ways you could invest in the internet back then. You can invest in websites, even though they went to zero. You could invest in infrastructure companies, some of which still haven't eclipsed their peak from 99. Um, you could invest in software, which obviously has done very well. That trend has exceeded hardware by quite a bit. But you can look through all these different technological changes and say, wow, that was great. How can I repeat that? Bitcoin, Ethereum, blockchain, any cryptocurrencies, stable currencies, Solana, like you go on and on of all the blockchain, right? And
But
then,
repeating that means picking the winners.
well,
And it means buying at a point where they will go up and not at a peak where you won't make your money back.
so here's the thing, right? So there's there's the blockchain technology that is evolving right now. It started in '08 and went through its phases where you had the hobbyists, the tech geeks who were in early on, the libertarians that thought it was going to change the world, the guy who paid a Bitcoin for a slice of pizza. You hear all these stories. Those are the early adopters. People now, they're more of the latish adopters. They're people that are getting in like I would say around 1995, maybe 1990, 95 is when people are getting into blockchain now, right? It still has a long um, progression, right? Bitcoin's like 100,000. Some people say it'll go to a million. Some people, Michael Saylor says it'll go to 20 million. Not sure if I buy that, but let's say it does. Um, that's a long progression from here, right? We have it's math, so you have an idea where it's going to go, right? Just based on math. Um, which is what a lot of people like about it. Just math, right? It is speculation. I want to be clear. It's definitely speculation, but it's based on user preferences of what they're going to use. Much like social media and the internet's, a lot of sites are networked. But if nobody networks, then there's no value in them, right? So it's all based on our usage. So there is some stickiness to blockchain, but it's being integrated all across the board. So how do you invest? Don't know. Like you can invest in Ethereum and Bitcoin and some other ones personally. You can buy ETFs. Sometimes you can buy an ETF that's filled with a bunch of companies that do it. But there's not a lot of opportunity to invest in cryptocurrency in the same way there was the internet. There's a lot of private ways. Like there's plenty of private ways. Public, not so much, which is a problem for most people because most people are not experts enough to invest in private. Let's look at AI. AI is even worse. You can't invest in Chat GPT because Microsoft owns it and it's not moving the needle for their performance. You can't invest in Anthropic. You can invest in Google, but you can't invest in their AI because it's just emerging and frankly, I don't really like it, but it's certainly not going to move the needle in their profits at the moment. So how do you invest in AI? Well, you can buy some infrastructure. What's that? Data centers, you can invest in Nvidia. That's why everybody invests in Nvidia. I'm not sure it's going to have the legs that it's had up till now, but you can. So where do you invest, right? Well, a lot of it's going to be private. And frankly, I've said this in the show, the best way to invest is in yourself. Invest in yourself with AI. Know how to use it, it's going to create everything you want in this world eventually because of the way that the progression is going. So you're going to invest in a company that might not be around in 5 weeks because someone else is doing the same thing. That's where we're at. So it's a big, I'm just using this frame because it's a big puzzle to think about. It's not as simple as just put me in an AI stock. Well, things have evolved since the 90s. It doesn't operate the same way. Small cap stocks are now still private. People don't go public until they become a mega cap stock and then they go public. So all the private investors are the ones getting the benefit, but we don't have the access as individual investors, we don't have the access or the insight in what to invest in. So it's a different game. It requires a different skill set for most people. And I don't know. I mean, what do you think, Barb? I mean, how do you invest in blockchain? I mean, you mentioned an ETF, or no, it wasn't an ETF. You mentioned VanEck Intrinsic Value, which I actually loved, by the way. Um, but but yeah, I mean, how would you do that if somebody really wanted to do it? How would you invest?
What would I do? I don't know. I think this gets down to speculation because, look, nobody knows the future about anything. One of the things Matthew said was his case for investing in Bitcoin was, well, the US government debt has just been downgraded. And so maybe in a case when the government is less reliable and their debt is less reliable, you want to have Bitcoin. Okay, I get that. I don't necessarily agree with it. I also understand every government has fallen at some point. So you have to ask yourself, is US gonna lose the momentum it's had for the past, 100, 200 years? Maybe, but we don't know the future. One thing that has served me well in investing since the 1980s is putting my faith in US and global businesses. I believe the whole economy of the world and the US is not going to go to crap. I really believe that. Now, are there going to be big dips in pricing of all assets? Yes, that will happen. Do I know when? I don't have a clue. Do I know which of the blockchain companies are going to beat the others and which ones are going to fail? I don't have a clue about that either. So, my thinking is either go in now and make a bet, either on a fund, on some crypto, on blockchain fund, individual companies. Make a bet with a small amount of your money and be prepared to lose it all. Okay, that's one way to go. Or go into a managed fund, accredited investors. Most of them are available only to accredited investors, but many people can access accredited investments if you're knowledgeable about the investment markets as well. So that's another option. These, I'd say, are the most speculative options. But if you're just going with a small percentage of your portfolio, the reward is gigantic. The risk is you only lose the amount of money you invested. So that's one way to play it. Another way to play it is just wait. I mean, it's not like people that didn't get in on the beginning don't have options. I mean, look, there are many dips of many assets where the company could be around for a long time. During a dip, you buy into it and you profit. So that's another thing to do. Wait for the next market pullback. And then, be it in crypto, be it in blockchain, um, be it in specific AI companies, whatever, and then buy in then. You will probably up your likelihood of having greater returns.
Yeah, and I think it's a good way to look at it. I mean, one thing that I'll say is going to be interesting is how the market is going to react to the evolution of cryptocurrencies. So, you notice Trump made Bitcoin a reserve asset of the country, which pretty much cements it as this is important. That was a big step, right? The government recognizing Bitcoin as a reserve asset. Um, I don't know where things go. Because government's government, and politicians are politicians, and they do a lot of stupid things and good things, and who knows where it's going to end up. But um, I do think that the progression is not towards it going away. The progression is towards an evolution of where it goes. Now the question is it going to be around in, you know, is it going to be around in 20 years? I don't know. Maybe they come up with a new one. Maybe something else happens. No idea, right? Like we don't know the future. But at the moment, it seems like some of the major cryptocurrencies are sticking around. It seems like blockchain is not going away as a technology because it solves a lot of our problems. Now people say, well, what about quantum computing? Oh yeah, do we have one of those yet? No, I'm not worried about it yet. A lot of people are talking about quantum computing and how it's going to disrupt computing. Yeah, and so is AI. AI AI is like dropping an iPhone in the Stone Age. Like it's totally out of place. Like it is going to disrupt society on every level. So, you can look at it many different ways, but I think the right way to look at it is how are you comfortable with the investment in this? Most companies will integrate this technology into their company, much like most people thought, well, pets.com is just going to take over. And it's like, well, actually, what happens is GE is going to set up their own website. We don't need to find jetengines.com. We just go to generalelectric.com and we go buy our airplane parts there. So I think the scope of what people thought would happen versus what actually happens is very different. And I think it's the same here, is that the scope is going to change as the technology changes. And, I just can't wait to see it. I think it's going to be a great evolution and it's going to help a lot. And I just hope that all these technological changes we are able to adapt to them because a lot of them are coming at us really quickly and it's very disruptive. So I guess we can kind of keep it a little short here, but Barb, what are some final thoughts from you on this topic, and what are some practical takeaways that people can take home with it today?
I have three practical takeaways. If you are a risk seeker, then go on, choose some investments, some crypto, some companies that you believe in, put a small amount of money in, and see what happens. If you're a little more cautious, then look at funds. There are now ways to invest in digital currencies through funds. Grayscale, there's a Bitcoin ETF. Try those out. BlackRock has come out with a ton of ETFs that are all in these newer technologies. I would say you're tapping into these, but you're not taking as much risk. So those are my two. And my third is time is your best friend in investing and regular investing. Like I said, I've been investing since the 1980s and I have been investing regularly since then. And over time, the compounding of wealth of very ordinary investments is stupendous. And so have some patience. Don't try and be a millionaire over life, but look at investing as something you do with part of your income in order to spread out the money you earn today over your entire lifetime. I'm Barbara Friedberg. I will see you on YouTube.
Great. Well, thanks for coming on, Barb. Appreciate the input as always. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.